Hello there, and we make sure we have the volume in. Hello there, we are live. I'm Mitch Goldberg with Client First Strategy. Thank you so much for tuning in to a new episode of Be the Boss of Your Money, because I want you to be the boss of your money, not your money to be the boss of you. You know, it's very easy for that to happen, by the way. It's very easy to lose control of your finances, to lose track of your finances, all the little expenses in and out, the big expenses. It just becomes one big distraction. Today, we're talking about the stock market. We talk about investing. We talk about business. We talk about personal finance on this show. Today's big question: is it enough with the airline stocks? Is it time for that run to end? That's a big thing, because it's not just airline stocks. Airline stocks are emblematic of what's been going on in the entire stock market for the last month for this big rebound, especially since we had the incredible jobs numbers that came out this past Friday, and airlines continue to lead the way. So we're going to roll the intro, and we're going to get into this. I'm going to answer the question: is it enough already with the airline stocks? Here we go. And we're back. Thank you for joining me. If we haven't met yet, my name is Mitch Goldberg. I'm a financial advisor. I'm with the wealth management firm Client First Strategy, and it is all about putting the clients first. Fiduciary, we don't manufacture products. Our only business is to serve the best interest of our clients. So without further ado, let's get into it. So I'm going to mix up today's topic, the airline stocks, which are really representative of the of a major part of the dramatic recovery we've had in stocks. Because it's not just airlines, it's cruise lines, it's retailers. So we're going to mix up the day's update with the question of the day about, is it enough with airline stocks? So if you are a viewer of the show, I'm going to do a share screen, and we're going to get into this. This is going to be good. I'm very excited about today's show. Okay, first we're going to go. It's so not the button that I wanted to hit right now, but that's okay. We'll get back to it. So let's make this one a little different. Okay, so you could see that today was a down day in the market, but since I just hit the wrong button, I kind of have to. How annoying! I had everything set up so perfectly. That's the beauty of life, though. You know, these things happen. Okay, the computer's running very slow, by the way, when you're live streaming. So we will get to that in a second. So today you saw the first decent down day. It seems like in a while. Okay, even though we've had plunging days 2 months ago, this is the first one that I feel like we've seen in quite some time. And we need to talk about that, because it was led lower by the very same stocks that people have been going crazy over. And I'm happy for people, because people have been making a ton of money in these stocks. So it's a good thing. It's a blessing, okay? But if you can see here, the Dow is off 300, not much, off a little over 1%. The S&P off less than 1%. NASDAQ, new high. You know, the NASDAQ composite broke through 10,000 for the first time ever. So we have a lot of good things coming out, even though today was off a little bit. The small caps, the Russell 2000, that was off the most of the major averages, down about 2%. And the VIX continues to go up a little bit, 27.57. The VIX is the fear gauge, and it's a measure of basically whether or not institutional investors are hedging their bets. So when you see the VIX go up a little bit or stay somewhat elevated, it means that there's a lot of fear in the market. And that's a good thing, by the way, because stocks are known to climb a wall of worry. And, you know, we need to keep a governor on things. Okay. So the VIX was up about 7%. The VIX typically moves in a much more exaggerated proportion compared to the major averages. So it's not unusual to see the VIX up, 5%, 6%, 7%, or down that much. in one particular day. So don't go like, oh my goodness, but that was up 7% the VIX. Again, you want the VIX to be down, not up. But let's not make too big of a deal about the percentage. The VIX is known to trade a lot more. Like, the Dow is off 1%, but the VIX was up 6, almost 7%. But it's not really that big of a deal. It's quite normal. Okay. So we're talking about the airline stocks. I want to put up a couple of quotes here. I'm going to look, this shows you the aftermarket trading as well. But if you look at Norwegian Cruise Lines, down 10%. Let me make this a little bit bigger. Maybe that'll help. I don't know if I can make it any bigger than this. Okay, we'll see. All right, there we go. So Norwegian Cruise Line down 10%. American Airlines down 8.67%. Wynn Resorts down 5.5%. And Macy's down 7%. And Simon Property Group down almost 10%. These stocks are basically the rebound stocks. These are the popular ones that people have been talking about. Okay, so again, Simon Property Group, Macy's, Wynn Resorts, the casino, American Airlines, and Norwegian. And you could substitute Norwegian for Royal Caribbean or American Airlines for Delta, Wynn Resorts for, another casino operator, Macy's. You could swap in another retailer if you want there. In particular, apparel. I'm not including Costco, Walmart, and Target in the same category as Macy's. Macy's is really an apparel store. Plus, most Macy's stores had to close while Target and Costco and Walmart stayed open during the quarantines and the social distancing time. And Simon Property Group is a big mall operator. Near me, they own Roosevelt Field. They own Woolman Mall in Florida. They own the town in Boca Raton. They own the town center mall. They own a lot of high quality malls. But that stock is down. The malls are in a lot of places are still closed, especially in New York, and that is down 9.5%. So is this the bloom off the rose for airline stocks at all? So there's a few things we need to talk about. First of all, if you're someone who's moving all of your money out of the pantry stocks, the consumer staple stocks, the so-called growth stocks, companies that can show their earnings and revenues can hold up okay in a recession or better than cyclical stocks in a recession. If you're getting out of all of those and into the cyclical stocks like and consumer discretionary stocks that we're just looking at now, it's really tough to do. And you're probably hitting it right now, but now you're going to have to make up your mind. Can you do it again and again and again? And my sense is you have both. You have growth stocks, you have cyclical stocks, and that's diversification, which is a strategy that we use to reduce risk. Diversification is not a strategy to maximize gains. It's a strategy to lower risk. Now, in a generally down market, it doesn't keep your account from going down, but it is a strategy that we do find helpful because when you go down less than you would have because you're diversified, you often recover a lot faster. So that's the story on that. So we're going to just stop the share screen for a second. My opinion is that the run in the airline stocks is not the end here. In fact, what happened is these stocks that we just went over, the apparel retailers, again, I'm not talking about retailers like even Home Depot, Walmart, Costco, Target, but Macy's in particular is a big name that his stock has dropped dramatically. Airlines, cruise lines, casinos, restaurants, hotel and leisure, travel and leisure. These companies were traded so low as if we were going to see just a giant swath of corporate bankruptcies. Now, the jury is still out. We could see some bankruptcies along the way, but even companies like Macy's were able to raise a ton of money in the bond market. So there is a lot of liquidity for a lot of these companies that right now are down and out. So the expectation is they'll survive. Now, this past Friday, we had a much better than expected jobs report. So the economy is starting to recover. The states are reopening, and the reopening is going pretty smoothly around the country. It's happening faster than people expected. Granted, some parts of the country are behind others, but it is happening. And that's why you saw these stocks rally so hard, because they were basically marked down for nothing, for death, for bankruptcy, and now they're going to survive. There could always be someone that doesn't survive, but by and large, the group as a whole. Okay, I'm really choosing my words carefully. So once that happened, and you had all the Fed stimulus, all the stimulus from Congress, you put all these together, and it's fair to say that we're going to make it through this recession. It didn't really. You could say we were in a depression for a short amount of time. Maybe we were worried about it, but it's really hard to say we were in a depression. The depression would have to last a much longer amount of time than what we're going through now. And when people, by the way, compare the stock market to 1929 or 1930 or 1931, I think it's a kind of it's a ridiculous comparison. Because back in the 1920s, very few people were in the stock market. The stock market was for speculators and for the wealthy. It wasn't democratized like it is now with tens of millions of 401k accounts and national TV networks dedicated to the stock market, and it's all we talk about today in the economy. The sophistication they have. It's a really silly example to compare things to 1929. We have social welfare. We have social policies in place. I can't even begin to tell you all the differences between now and 1929. So let's just get those comparisons out the window. It's stupid. That's why. Get them out. So what happened is money managers started to fall behind the eight ball. And once the S&P 500 crossed above its 200 moving day average about a week and a half, 2 weeks ago, we've been talking about that on the show. It gave a signal that stocks are going to be okay. Companies are going to we're going to avoid the bankruptcies that we thought we would have. And then fund managers, hedge funds, professional investors who got way behind their benchmarks because they thought the market would go lower, or they thought they would get out of stocks and go in when things went even lower. Once the market started going up, they were in panic buying mode. They were performance chasing. They had to get invested very quickly because of the pressure of falling behind their benchmark so quickly. So you had a massive rush of cash going back into the market. And what were money managers buying? The deep cyclical stocks, high beta stocks, companies that can move a lot from an improvement or perceived improvement in the economy, which would be airlines, cruise lines, consumer discretionary stocks. And that's why you saw such a giant rally. Plus, you also had a few biotechs that have gone up a lot now. Some of them are backing off. So that's why they've rallied. But now that they're backing off a little bit, yes, this backing off could last a little while, but I don't think it's a long-lasting pullback. My sense is that once they come down a little bit more, I think money managers are still pressured to add more money to the market, buy more beta, more of these kinds of stocks. And I think they're going to buy the dip, and we'll get through this dip. So that's what I think is happening. I don't think we're just suddenly going to retest the March 23rd low in the S&P 500. I don't think, the Dow is up 9,000 points about since the March 23rd bottom. I don't think the Dow is giving back 9,000 points again. So that's where we stand. I think we could recover. There's a few people out there. Let me just see who's out there. Hey there, Bill. Good to see you, man. It's always a pleasure. Thank you very much, sir. And I appreciate your support. Thank you. So let's move on and let's get back to the screen share. I want you to know that my barometer, my benchmark for keeping track of what I'm looking at is actually Boeing, because Boeing it's the biggest manufacturing company in the country, one of the biggest in the world. Yes, they have their problems with the 737 MAX, and they're working on it. There's right about now they're starting up production again. The news on Boeing today was that they're losing more orders than gaining new orders. That's not new news. That is, as far as I can tell, that's been known for quite some time. Boeing was under 100. It was like $89, $90, and now it's over 200. So if some of these stocks are up more than double in a short amount of time. They've doubled. It makes sense that they would give a little back, a little bit of profit taking. So let's not be let's not get spoiled about it. I want to go over Chesapeake and Hertz. Hertz was down 24%, down to 4. It was as low as 40 cents. And Chesapeake, it was off. Is that right? It's off 66%, down $46. And these stocks, Chesapeake and Hertz, I think they're worth mentioning because they're pretty popular stocks on the Robinhood app. Hey, I have no kick against the Robinhood app. I'm very happy when people make money. The Robinhood app is where the millennials, it's known for the millennials and zillennials, Gen Z, to trade there. And the Gen X and the boomers, they're kind of looking at Schwab and TD Ameritrade. But you see, it's fine for Robinhood and millennials because they're making money doing this stuff at the moment. Yeah, they could lose money, they could get squashed, they could get hurt, they could. But what better time to learn about this stuff than when you're young? So more power to you. Learn a lot. Try not to overdo it. And you'll just have to learn for yourself what your own threshold for pain is, your own threshold for greed is. And it's an experience, but at least you're getting the experience because that is, I think, ultimately the best thing to do when you're starting out. It's not necessarily, about maximizing every penny. A lot of them are just trading, but you learn a lot. When you trade, you learn fast. So Chesapeake down a lot, Hertz down a lot. These are basically bankrupt or near bankrupt companies. And typically when that happens, the stocks do get marked down to zero. So people are trading these. It just shows you that there's a good amount of froth built up in the market right now. I call these hot potato stocks because it's the greater fool theory. Just you buy it and you just want to sell it to the next person who, the next sucker who's going to pay up for it. Okay. That's what these are. These are sucker stocks. I'm not calling American Airlines or Norwegian Cruise Lines sucker stocks. I think it's fair to say they have a really good shot to survive, but not Hertz and not Chesapeake. In fact, one analyst actually put, I forget which firm, put a sell rating on Chesapeake with a 0 price target. I don't think I've ever actually seen anyone put a 0 price target on a stock. Okay, so let's keep going. Dow 30 stocks. You see Boeing down $13. But listen, like I said, Boeing was under 100 recently. So the fact that it's over 200 and it backed off 6%, not the end of the world. Dow Chemical backed off $1.49. That was recently 30. So now it's 44. And you could tell all these companies. I mean, Disney was around 90, backed off a little bit, nothing major. All right. So just to let you know what led the Dow down, we already covered the major averages. And that's really, really about it. So if you're in the airline stocks and you think, here's how to play it. If you bought the airline stocks, you're up a lot. You took a shot in some of these deep cyclicals. There's nothing wrong with taking some profit and go home happy and use the money for something else, redeploy it somewhere, maybe even buy back the same stocks you sold if they go down. This is reminiscent of previous bull markets. So I've been doing this for 30 years. And I remember in the, I'm going to in this presentation in a little bit. Yes, Jay Spindell. Jay Spindell is a hedge fund manager and madness of crowds. Yes, indeed. Thank you very much. And yes, sage word. Hey, man, thank you very much. I appreciate that. Thank you. By the way, I appreciate all your all of your wife's live streams in Manhattan with everything that's been going on in the last week. It's actually been better than watching the news. You guys have been, a lot of my friends are in Manhattan. I've been doing a lot of live streaming on Facebook with all the, the protests and the riots and everything. And it's been pretty eye-opening. And you're seeing a lot of things, some better, some worse than what you'd see on the news. It's almost like being there. It's incredible. So, I remember how easy it was to make money in the internet stocks, 99, 98, 99, early 2000. And there were a lot of people who were not experienced investors. They were going on, E-Trade for the first time, Ameritrade before it was TD Ameritrade, and they were making money on these stocks. And thank you, Jay. I see that. She's the best. I'll keep her. Good for you, buddy. I think that's your best decision ever. Okay. So and people were buying these stocks on their own, and it was great. And then they tanked, they crashed. I mean, Amazon went from like $100 to maybe $5 a share, and that was looked at just like any other crappy internet stock that wouldn't survive. Yes, I just said that about Amazon. Apple almost went bust twice. Incidentally, Apple and Amazon hit all-time highs today. So there were a lot of good things going on today in spite of the averages. Today's sell-off was very orderly. It wasn't really anything disastrous. Just to me, it was a very quiet day, very small pullback. And then I remember in 2007, and then earlier this year, people get caught up and they start to think that they're smarter than they really are because their stocks went up, and it validates them. So if you buy a stock, it went up, I must be smart. And don't let yourself become overly validated when you buy a stock that's up. You have to also take into consideration that whether if you know it or not, you've become much more acceptance of risk, and the risk cuts both ways. And I'm telling you, in my experience, there's always a price to pay. It's just we might not see it for a while. So I just want to share some advice for those people who are trading these stocks and who are new to trading and all of a sudden jumping on the bandwagon with the deep cyclicals that we talked about. All right, that's it. I will speak to you guys soon. If anybody else has a question out there, words of wisdom, words of encouragement, speak now, or you could always hit me up in the replay. Actually, I was going to say forever hold your peace, but you hit me up in the replay. I'll be looking. Okay, I'm going to go. See you soon. See you tomorrow.